Happy Friday, traders. Okay, the markets are in a very happy place at the moment. We've got US equities back at record highs and risk ripping globally. Look, one of the things that certainly is helping this happen is that we have seen a big, decent move, meaningful move in US bond yields lower. US bond yields have been stubbornly high for an extended period of time. Higher bond yields is not good for governments, it's not good for corporations, it's not good for individuals, it's not good for the market, it's not good for anyone. And the reason why we've had the stubbornly high US bond yields, been a few reasons, but one has obviously been tariffs. Market has been concerned that that tariffs would lead to higher inflation, so they've kept the bond yields high. Market's now getting more comfortable that potentially we're not going to see a big inflation hit from the tariffs, and we haven't seen any evidence yet that that's going to happen. So we've seen bond yields lower on the back of some relief there. And the second thing is just recently, obviously, with the war between Israel and Iran, market was super worried that crude could spike and spike potentially up to $100 or so. Crude's the biggest input into inflation. Those sort of levels are very inflationary, so they kept bond yields higher. Obviously, now that the war is over, crude has dropped like a rock, back down towards fair value around $65, which is not inflationary. So yes, we've seen bond yields lower again. So if we have a look at US 2-year yields, they were sitting above 4%. And now they are at least 30 basis points lower, down towards 3.7. It's a big move. And US 10-year yields, which were sitting around 4.5%, which is a real worry for the market. They didn't want those going anywhere near 5. But now they've dropped down towards 4.2, so they're off about 30 basis points as well. And if we also look at the Fed Fund futures market, is actually a week ago was pricing in around 49 basis points of Fed cuts for the end of the year, and now a week later the market is pricing around 65 basis points of Fed cuts towards the end of the year. So what the bond market is basically saying is that they are getting very, very comfortable with the Fed cutting rates, and certainly that will be something that will please Donald Trump, because he has been very aggressive in his attacks, even on Powell recently. Okay, so if you are obviously trading equities and risk in general, the key takeaway is you need to be watching these bond yields. If they continue lower, yes, this is going to be very risk positive. And we will see, equities, etc., higher. Now, for the US dollar, the dollar basically trades with bond yields. So if those bond yields are, spike higher, US bond yields and outperform global bond yields, that's a positive US dollar story. But seeing those bond yields, US bond yields drop like a rock recently, that has been a big sell US dollar story. The euro has led the charge, up towards 117 now. A lot of analysts are looking at euro and thinking that 120 targets for the end of the year. Look, that's only 300 points, 3 big figures away. Certainly, why not? Realistic sort of targets, I guess. The other currency that I really like, the risk currencies. You look at the Aussie, for example. Aussie's at multi-month highs now. Testing, important technical level around that 65.5 area. Breaking that, which obviously it's working towards at the moment. We could see Aussie definitely take a next leg technically higher. But yes, I would not be selling Aussie, and I would not be buying the US dollar, because at the moment it suggests that the momentum is certainly with this trade in the market, and it is across the board, and is quite, we've seen quite aggressive in the last few sessions. In the commodities space, commodities love lower yields, and they also trade inverse to the US dollar. So when you see US dollar sell off, it's another tailwind for commods. For gold though, Yes, it is obviously helping gold, those two factors. But one of the things that gold also had was a risk premium built in. Obviously, with what's going on with the war recently, that's been taken away. Also, a lot of the tariff headache has been taken away. So look, I think I don't see a big trade being long gold, even with the tailwinds of lower bond yields and lower US dollar. So anywhere above 33.50 towards 3400, I think it's going to be hard going. But the precious metal I do like is silver. Silver loves risk bid, loves the tailwinds. At the moment, we saw a recent high of silver up towards 37.30, which was 13-year highs or so. No doubt breaking that. The next sort of targets you're going to look at is $40. And if we do see a continuation of what is happening in the market with this risk bid and dollar lower, yields lower, yes, silver could outperform it, and that's definitely the pick out of the precious metals at the moment. Crude I wouldn't really be touching at the moment. It's back at fair value. If for whatever reason it sold back down towards $60 with risk bid, I think that's gone a bit too far. In crypto land, Bitcoin, yes, it is bid, but it hasn't gone back above 110. We haven't seen any record highs at the moment. It's sort of lagging a little bit. Maybe all of the crypto bros are out there buying equities at the moment. But in any case, to end the week, there's not too much as far as event risk goes going into the weekend. So I'd imagine the risk party will continue, and I'd suggest staying long risk until something comes out from left field to say otherwise. Good luck with your trades. Have a great weekend, and we'll catch back in with you next week.